So what's everybody's plan for tomorrow, Monday? Any big trades you're looking at? Let's see, stocks for tomorrow. Usually you do the opposite of what the prior day did. So if the market went up a lot, like on Friday, the last trading day, it's likely to go down. And if it went down, it's likely to go up. Like when there was that big sell-off 2 weeks ago, then the following trading day, there was a lot of buying. And when the market went up like 7%, I think it was Wednesday, right? The following day, it dropped. So anybody looking at anything in particular? Let's see what Yahoo Finance says. So these are trending stocks. How do they measure this? I guess the people who are looking, how many people are looking at a stock? Netflix is number one. HUD 8, if you're into crypto, you got HUD 8. The Trade Desk, if you're into software. Pepsi, usually Pepsi doesn't move too much. It's kind of stays stagnant. So I just did a video on Eli Lilly, and it seems pretty overvalued, at least according to my model. Because, I mean, look at the bigger than Lilly for like forever until recently. It has double the revenue, but it's like 40% smaller in terms of market cap. So why are people willing to pay $658 billion for Lilly if revenue is half? Because growth. Their 5-year annual revenue growth rate is 15%. Johnson & Johnson upholstery 2%. The number one in terms of growth is Novo Nordisk. That's the weight loss drug. Wegovy. And Ozempic. That's pretty much what carried Novo Nordisk to these levels, to 283 billion. Ozempic. What's up? Mylan? Is that Mylan? Yeah, Mylan. So Ozempic, I wonder what the revenue is for Ozempic. Let's see. Hopefully they have usually companies list revenue by product in their annual report. But is this yeah, they might not on this. So this is good to look at. So if you invest in a pharmaceutical company like this company, I'll give you an example with Viagra. Pfizer, I think it was in 2000. So Viagra in 2000. So when a company gets clearance, like they go through all the trials, all the FDA trials, because in order to get a drug approved and to get a patent, you have to do a lot of testing. You have to test on a lot of individuals, different groups of people. Then you have to there's phase 1 to 3. So each phase has more testing. So maybe you'll raise the dosage in a later stage or test to a wider group of people. Maybe in phase 1, you just test to white people under a certain age or black people over a certain age. But then you have to kind of like, you have to go all demographics. You have to test it with Spanish people, younger, older, black people, younger, older, all those age groups, because certain drugs affect certain groups differently. And once you finally pass all the phases and get the drug patented, which means you can legally sell the drug, then that's when the clock starts ticking. Then you have 20 years. The patent is only good for 20 years. So I think Pfizer got their Viagra patent in 2000. So they could only sell Viagra from 2000 to 2020. Only Pfizer can sell Viagra. Once the patent expires, which it did in 2020, if my numbers are correct, nobody can sell Viagra because Pfizer owns that brand. But anybody can sell the generic version of Viagra and call it whatever they want to call it. And a lot of people will buy the generic version because it's a lot cheaper than buying the name Viagra. Usually you pay for a name. It's kind of like with clothing too, or any kind of product. A lot of times you're paying for the name, not so much what the product is. A lot of times you can get, like if you go to the grocery store, you can get pasta for $5 for a bag of pasta. And then next to it will be like this a generic name, which no one's heard about. And it's $4. It's the same exact thing. So after it expired, the patent, of course, Pfizer is going to still sell Viagra, but now people will sell their version of Viagra. They can't call it Viagra. They call it whatever they want. And it does the same exact thing as Viagra, and it's probably half the price. So usually sales go down once the patent expires because all the competition comes in. But there's still gonna be demand for Viagra because people feel more comfortable buying with that name. It's psychological. I have a question that a lot of people probably have asked before. It might be annoying, but what do you think of the intrinsic value? What do you think of the intrinsic value calculator? The intrinsic value calculator, what is that? Is that like on a website? It's kind of it's probably similar to what I do. It's just a discounted cash flow model. I mean, it's helpful to kind of get like a more of a broad view how much a stock is worth based on the future expected cash flows. But it's just one tool in figuring things out. If it was that easy, everybody would be rich because it's just a calculator. But you have to do a lot of kind of assumptions to put the data in the calculator, because you know what they're doing now. You know what their revenue was in the past, and you know what their free cash flow was in the past, and you know their WACC, but you don't really know the future. So it's helpful just to kind of get an idea of. It's kind of like weeding people out. So if you're hiring one position at your company and you get 100 resumes, you might just say in order to get an interview, you need to have a bachelor's. So just weeding out, because you can't interview 100 people. So you cut it down to 60. So out of the 100, now there's 60 left with a bachelor's. And then you may say they have to live within a 45-minute drive from the office. So now it's down to 40 people. So it's like the DCF. You're just weeding out like the obvious bad candidates, or what you think is obvious. Because some of the people who gave a resume, they might not have a bachelor's degree and they might live an hour away, But if you did hire them, they would be the best employee ever. But you'll never know that because you can't, like, it's impossible to interview 100 people, for instance. Same thing with stocks. Like, you can't look at 50,000 stocks. You just have to weed it out. Maybe eliminate stocks that have never had a profit, or eliminate stocks where their debt is over a certain number. Who created Cialis? So that's a good thing to look at with the with these types of companies. Look at their big drugs, and when does a patent expire? Because once a patent expires, revenue goes down a lot. So they have a lock on the market in US up to 2032. So nobody can sell the diabetes drug Ozempic until 2032. But once that expires, then people can buy the generic version. So Cialis, Lilly, Eli Lilly, it looks like. And I guess on this talks about Cialis, Tadalafil. I don't know how to say that. Tadalafil. That's the kind of like the medical name of it. The street name is Cialis. It's easy to say. This name is probably what the scientists call it when they're doing research. Okay, so Cialis makes impressive strides in first 6 months of the US ED treatment market. So this is for ED, so for men's, which is a pretty good drug. There's going to be a lot of demand for that. If you want a drug that makes a ton of money, like that's how the scientists do it, or the doctors, or the CEO. They look at if they're going to do all this research. Say it costs $100 million from start to finish in order to get a drug patented, because you have to pay a lot of payroll, you have to do a lot of testing, you have to pay a lot of fees to the government. So say it takes $100 million to get everything done. They obviously need to make at least $100 million in profit if that drug does get approved. So they would look at how many people could the drug possibly help. So they look maybe, okay, how many men, if they're just looking at the US, so how many men between the ages of 30 and 50? So I'll just ballpark it and say, there's 30 million men in that age group. Then you have to look at, like, of those 30 million, how many would actually buy it or can afford to buy it. So how many people have insurance? So they just kind of give you they get an idea. So say it's down to like 7 million. That's the possibility if they get it approved. Then they look at how much money, like if each person spent, a certain amount, because if you spend like $100 on a prescription, the Eli Lilly is getting a lot more because of insurance. So they have to look at how much money they would get if it's like $1,000 a year from the patient and insurance. So that 7 million times $1,000, so that's 7 billion, right? Yeah. So that's kind of their cap. They're like, we can get $7 billion a year in revenue if this goes correct. And then obviously a lot of that doesn't go to them because they have to pay to make it. Then they have to do advertising, things like that. Okay, everyone's getting a new drug. So you generally want a drug that has casts a wide net. So Viagra is a good one. Even better is weight loss, cancer, heart disease, because that reaches like cancer and heart disease probably reach to most people because everybody, it's probably close to 100% of people will need those two things at some point in their life. Not when they're 20, but maybe when they're 60 or 70, they may get cancer or they may have heart problems. But then you have to look at like demand, and there's competitors. So even if it's a drug that's maybe doesn't cast as wide of a net, maybe a certain disease or if there's a certain problem, like maybe Latin people have, Latin adults, they certain like who are over 60, like if it is a certain disease that kind of hits that demographic more than the average, so then you have to kind of narrow it down, and you may end up charging more for a drug, especially a specialized drug that doesn't have much competition. Because weight loss, there's going to be a million people trying to make money on weight loss, but if there's a specific disease that affects Latin people over 60, there's not going to be that many people creating it, so you could charge more. But this is just high level. To really see the numbers, I wonder if they actually talk about it. They probably do in some of the reports. It'd be interesting to see. But if I had, like, if I looked at like drug companies, I would just narrow it down. Like, I'm going to just stick with companies over 10 billion market cap, stick with companies that have been around more than 50 years, and then if I narrow it down to 2 or 3 companies, then I can maybe do a little more deeper dive into something like this or read up about it. But this is how you learn, because you're blind, you're just kind of reaching for something, and then it starts to kind of click after you do it enough times. I was thinking of doing like going through like, but these things tend to be boring, like going through the income statement or balance sheet and then just trying to explain each thing. I've done similar videos, like for example, the income statement. This is Eli Lilly, and just go through what is revenue. It's pretty basic, but like what numbers feed into that revenue number. That's pretty easy that's transparent. I think people get what revenue is. But things like acquired in process R&D, like what does that mean? And what companies make up that? Because the acquired in process R&D is when you acquire another company, and that company is in the stages of R&D. It's currently researching and trying to develop a new drug. So if you acquire a company that's in that stage, then you report it on the balance sheet as acquired in process R&D. Every pharmaceutical company is doing R&D pretty much. But if you acquire a company and they're really close to coming up with a drug, and they spent a lot of money on payroll, so that company has been carrying it on their balance sheet for a while. So when you acquire them, then you can report on your income statement. But if it's a small amount, if it's like $10 million, like you acquire a smaller company that doesn't really do R&D, you don't need to report it like a line item like this. What are your thoughts on the recent increase in interest rates and what to avoid? Spliff Meister, thank you. What I didn't even realize interest rates have gone up. I didn't even realize they. I mean, tariffs. There's like a black cloud. It's of tariffs, and that's all you focus on, and everything else kind of gets. So interest rates, have they gone up? I didn't realize it was that much. Let's see. I'm sure it did. I'm sure it changed, but I didn't realize it was significant. I wish this chart was. Okay, here we go. I want to get a chart with a little like not like 100 years of data. Gonna be hard to find what I want. Um, I mean, I don't think rates have changed that much for me to be too concerned. Um, why can't you look at this on a smaller scale? Oh, it's right here. Let's see, January 2021 to March 2025. Okay, so this is the Fed funds rate, which is kind of like the like the default or the benchmark. Like this is like the beginning rate. You would always pay higher than the Fed funds rate, but this is the rate banks can borrow from the government at, and of course the bank would charge more. So it looks like it went down, unless it went up, because the Fed funds rate in January 2023 is the same as January 2025. It did go up at one point, but it came down. But it's kind of like if rates go up a lot, who gets impacted? People with debt, because it's kind of like, especially adjustable debt, because at some point you're going to have to pay down the debt or refinance it. So if you have if you have $100,000 on your home and you pay 5%, and if rates go up to 6% or 7% or 8%, it's more and more appealing your mortgage, because everybody out there is paying like 8% if rates go up a lot, and you're locked in at 5, you're killing it. But if the reverse is true, if you're paying 5 and rates go down to 3, you have a bad financial instrument. You're paying a lot more than everybody else. So you would refinance at a lower rate. But when I say debt, I'm talking about like companies with like, 100 billion of debt, and that have notes due every year. They have something due. So those companies have to refinance the debt at the higher rate, because they usually can't pay. Like a company like AT&T has probably 200 billion of debt, and say 20 billion is going to be due this year. They don't have the 20 billion to pay it, so they just have to take on new debt to pay the old debt. So as rates go up, it affects these types of companies with a lot of debt, because it's like the U.S. government can't pay all the debt. They have to just keep refinancing the debt, and if rates go up a lot, it's going to it's a lot harder and more expensive to refinance the debt. As rates go down, it does make it a little more appealing and beneficial to get locked in at a lower rate. It was a speed and froth of the rate change that was upsetting. Yeah, what's maybe Yahoo Finance has do they have like a ticker for the Fed funds rate? But the U.S. government, we kind of like, we try to, as best as we can, is try to keep a smooth economy, like not too many disruptions. So if we would have raised the rates pretty drastically, pretty quickly, that's a big disruption. Same thing with lowering the rates, but when you lower the rates, it helps a lot of people. The only good thing about higher rates is that if you have if you're paying a fixed rate, the value of your debt, it goes up because you're paying lower while everybody else who gets a home has to pay a lot higher rate. But yeah, I don't think it's too concerning. I think the tariffs is more of a focus. It increased from 4% to 4.6%. Yeah. It's the open market. Yeah. Okay, so I'd want to know, like, if I was to look at, I think drug manufacturers are a good industry to invest in. So if I was to look at Novo Nordisk, 208 billion market cap. So what percent is Ozempic? We know they're locked into 2032, at least in the US. In China, that's going to expire pretty soon, but I think most of their sales are in the US. So this shows you their market share, diabetes value market share. So 55%. I think that's this company's market share in diabetes drug. Is that right? Let's see if they have to have it somewhere. It might not be this report, but I'd like to know. This looks like it, right? Yeah, here's their revenue. Okay. Okay, so this makes sense. So Novo Nordisk, 207 billion. So that's 2024 revenue. Ozempic, is 120 billion of the, oh, it's right here, 270. Wait, why does mine say 207? Oh, I'm looking at the 283. Okay. So their revenue for 2024 is 270 billion. I think it excludes something. There's rare diseases also. So 290 billion, but it looks like most of their sales are obesity and diabetes drugs. So of the 270 billion of revenue, 120 billion is Ozempic. So it's like 40 something percent of their revenue is Ozempic. So it's kind of like they're very concentrated on Ozempic, very concentrated on weight loss. But they are locked in for a few years, their patent. That's probably why Novo Nordisk is fourth in market cap. Like Lilly is by far the largest. And people probably aren't willing to invest that much into Novo Nordisk because they're kind of a one-trick pony in a sense, where it's all Ozempic or nothing. Because without Ozempic, they would be like close to the bottom. So 120 billion. So in 2022, it was 60 billion Ozempic revenue, and that doubled. So can it keep growing at that pace? And there's other diabetes and obesity drugs they sell. Ribulus is 23 billion. That also doubled from 2022. Victoza, that's down more than 50% from 12 billion to 5.4 billion. But this is kind of like the due diligence process. You don't really need to look at every drug, but if you were going to invest in this company, you'd want to look at Ozempic, of course. When does that expire, the patent? And then the second biggest is Ribulus. I'm probably saying that wrong. 23 billion. So you want to look at that as well. And then there's an $18 billion one, fast-acting insulin. 18 billion, and that's pretty much flat. It was 17 billion 2 years ago, so that really hasn't moved too much. Their growth is these weight loss drugs. What do you think about GlaxoSmithKline? Yeah, we could look at them. So it's kind of easy, somewhat easy, I guess, relatively, because you just have to focus on one drug and look at that and try to read up on it. Obviously, you want to see when the patent expires, which we already did. You don't want to see because a company can sell a weight loss drug which is kind of similar to Ozempic, until 2032. Well, in China, a company like Pfizer can sell weight loss drugs in China. They could use the same ingredients as Ozempic, but just call it something else. Ozempic, biggest competitor. So Wegovy, which Novo Nordisk also sells, is probably the biggest competitor to Ozempic. I think they're pretty much the same thing, right? Or am I wrong? I thought Wegovy and Ozempic are similar. Then you have Saxenda and Zepbound. I don't know. Okay, so it's all Novo Nordisk. They make all these weight loss drugs, I guess because they have the patent. Lilly makes Zepbound. It's so hard to say. Zepbound. It's to treat type 2 diabetes with diet. So I guess you can have somewhat similar, but there can't be too much overlap while Novo Nordisk has the patent in place. And you can see the insulin. I think that was one of their big money generators. The patent expired, so maybe that's why their revenue is flat from 2 years ago. So just because your patent expires doesn't mean you don't sell that product anymore. But like I said, it opens the floodgates for competition to come in and sell it, the generic version, for a lot cheaper. Here's Victoza. But this is kind of like the learning process. I'm just kind of learning this right now. But next time you start reading up on, these types of companies like Pfizer, you just have a little more ammunition. But it's like Coca-Cola. They a lot of companies sell cola. And I bet you some, if you did a taste test, like you didn't know what you were drinking, you have like 10 cola drinks or whatever, 5 cola drinks, Pepsi, Coke, RC Cola. I bet you couldn't even tell. But why do people buy Pepsi and Coke? It's just that connection with it. It's the brand name. And same thing with drugs. And people are willing to spend more money. Like some people are willing to buy a can of Coke for $1.50 as opposed to buying a can of their competitors for $1. So they get willing to pay 50% higher. Same thing with drugs. Sometimes I feel more comfortable buying a certain drug that has a good brand name, even though I kind of know it's the same thing with the generic version, but it just, sometimes things are psychological. And you don't even know why. It might actually be better than no frills version, but just it gives you like a peace of mind. Let's see if this makes sense. This might be kind of hard to read. So Victoza expired. It expired everywhere, all around the world. I don't know when it expired. I'd be interested to see, but this kind of makes sense. So Victoza, they had 12 billion of revenue in 2022. Then it went down to 9 billion. Now it's 5 billion. So that makes sense. It expired because there's going to be people who buy Victoza. If, say, the patent was still there in 2022 and that's when it expired. So there's going to be people who are going to continue buying Victoza, that name. But as time goes on, there's going to be new people entering the market. It's the same thing with Viagra. If I started taking Viagra at 40, and the patent expires when I'm 60, I just may continue taking Viagra because I know it works. But if somebody was 20 and the generic Viagra, whatever that new company calls it, they're 20 when Viagra first comes out, and they don't need it and then they turn 40, and that's kind of the time they need to take Viagra. But they never even taken Viagra. They just the doctor tells them you can do Viagra or you can do generic, and you ask the doctor, well, what's the difference? Just Viagra costs you $50 a month. The generic costs you $10 a month. I'll take generic. Brian, what's up? a stove at Lowe's was 3,200, is now 4,800 easily. Definitely, Mike, especially with patents, and things are just so expensive. I'm not patents. Um, even before Trump's tariffs, I remember in 2019, you can buy anything. You can, say a toaster oven for like $80. 2019, and in 2020, it seems like since COVID, everything got so expensive. And then in 2025, that same exact toaster oven's like 180 or 160. Just everything just got so expensive with inflation, all these things. This is just another thing, tariffs. But I really don't think tariffs are that bad. Like, I get it. I get it. Like, it's going to make things more expensive, but you just deviate. If my rent in my apartment is $3,000 a month, and that's kind of like my comfort level. I mean, I could go a little higher, but that's kind of where I feel comfortable. And say I need to move, and if things are just more expensive, say I locked in the 3,000 years ago, I got it for 2,500 years ago, and he's only been increasing it 100 a year, my monthly rent. And if I want to get a similar type of apartment, say he sold the house I live in and I can't rent anymore. If I wanted to spend 3,000, like this place is say 1,500 square feet. And if I'm looking around 3,000 rent and it's mainly 1,200 square feet, then that's just how it is. I'm just going to have to rent an apartment, a smaller apartment for the same price I was doing it before. I mean, I could go up to 3,500 a month because that's the 1,500 square foot apartments in my area. Most of them are around 3,500. I could pay more. So it's up to me. Do I want to pay more for the same space or downsize? So people like that. That's just how people are doing it. Things get more expensive, so you downsize, or you just don't buy it. I used to go out to. I'm just giving you an example. I used to go out to dinner once a month, and it was $150 for me and my wife. And now everything's getting so expensive, so I just go out dinner every other month, unless you're willing to eat the difference. And now it's $200 every month for me and my wife to have dinner. So you just have to kind of decide. Any hot product that's going to have competition on the horizon, you may have to look at the strength of the moat. But the thing is, with like apartments are good ones. There's going to be, and let's say logically, this is what happens. It's 2025, and I pay $3,000 for a 1,500 square foot apartment, and then my landlord may raise the rent to 3,500, saying this is just the market rate. So then 2026 comes around, I pay $3,000 for a 1,200 square foot apartment because I'm not willing to spend more money. I could handle smaller space. But it's not like there's nobody that's interested in now paying. So my landlord raised it to 3,500. So there's going to be a group of people, a lot of people who are paying 4,000 a month for an apartment, and now they go down to 3,500 because that's just how much 1,500 square foot apartments are going for. So there's going to be people who are when they downsize, they consider downsizing to pay 3,500 because they were paying 4,000 before. And you go down, and then the person who was initially below you was paying 2,500 a month for a 1,200 square foot apartment. So there's just and some people aren't willing to aren't willing to change their lifestyle, and they can handle paying an extra 500 a month. Um, so what? So what? So I don't know if that's a good idea. I've done something similar where I go through. I could pick any company. Like I go through each line item and explain more about it. Um, but I guess let's look for So what's everybody looking for tomorrow? Let's see spiders. Okay, so here's the S&P the past month. It was 555 on 313. It pretty much traded sideways from 313 to 42. It didn't really move much. So you could have bought the S&P 500 565 on 42. If you waited till 44, just 2 days later, it went from 565 to 505. I mean, you would have saved like 9% if you just waited 2 days. Or if you waited another 2 days, it went from 565 to under 500. You could have got it as low as, it looks like, 497. So you could have easily saved 10% just by waiting a week. Of course, how would you know that? But if you had cash, you were sitting on cash, and then you see the S&P goes down to 500, that could have, bells could have went off, and like that's a good entry point, and you could have made a great return. So where's it going to go next? So like I said, like if the market goes down, especially if it goes down a lot in a day or a week, it's more likely to go up. And if it goes up a lot, especially real fast, it's more likely to go down. I mean, I don't know long term, but I'm just saying just basic logic, because and you could look at options trades to verify what I'm saying. But for example, there's a lot of people who trade the S&P who are waiting for an entry point, any stock. So if 550, so if it was, and that was, I think, March 4th. So 550. So if it was March 4th and it was 550, there's going to be a lot of people who are putting in orders, because not everyone buys at the market price. A lot of people put in an order. So they might put in a buy order. And they're like, okay, if it goes down 5%, so 523, they're like, I'll put a buy order for like, 8K, whatever, $8,000. So once it hits 523, all those people who had buy orders, they buy the stock. Other people might have buy orders. It's like if it gets to 10%, okay. So for March 4th, I'm doing it as an individual because I think it makes more sense. But you could think of like there's, $100 million of buy orders at 523. And then there's, 300 million at 495. So once it hits, anytime a stock goes down, there's going to be somebody that's going to buy it, even if it goes down $1, because a lot of people have these orders in place to buy or sell. Usually, like, people put in sell orders even when a stock goes down, whether it goes down or up. Most people put it in when it goes up. So if it was the opposite, if it was 495, which it became, what day was that? On 4/8. So once it's 495, people will put in sell orders. If it goes up to like a certain number, then they sell. So generally, as a stock goes down, people will automatically buy because they have the orders in, or just people who track the market, like us, will see, oh, look at that. The S&P 500 is below 500. I'm going to buy it now. Or Netflix is below. So that's just how mathematically it has to. Those orders will go through. So that's why generally when the market goes down, unless there's an enormous amount of fear, but I think people are pretty comfortable with the market, then these buy orders execute. Or just people who follow the market like us, they're like, oh, this is a good time. It's below 500. It's finally below 500. I'm gonna invest $20,000 into it, and then of course it goes up because people are buying, and then once it hits a certain point, then sell orders come into effect. And of course, this could change. Like, the reason it came down was tariffs. A lot of people got scared, and I helped some people manage their money, and somebody's like, sell all my stock because of tariffs. I mean, it's their money. I'm like, well, they want to sell it down here. I didn't say anything. I just sold it. But in my mind, I'm like, this is when you buy it. You don't sell when it goes down 10%. You won't buy. You buy, right? When the market goes up, you should be more likely to sell. When it goes down, you should be more likely to buy. But everybody does the opposite. I'm guessing tariffs around 10% may persist. TSM, yeah, Taiwan semi, that's a good one. I was thinking about that too, in terms of tariffs, things like that. But like everything, the fundamentals on any stock have not changed. Like, they have a good example. What is it? I can't remember how much it is. Like, so say the average iPhone price is $800, and with the China tariffs, it's $1,300. The amount Apple has to pay in additional taxes to the U.S. government for importing products. And if it's U.S. made, the same exact phone that's U.S. made is $1,900. So Apple will continue importing from China because it's a lot cheaper to import from China and pay the additional fee than U.S. made. Of course, Apple wants to pay $800 for an iPhone, or they want to sell an iPhone for $800, and they were able to sell it for $800, but now with the tariffs, it cost them $1,300. But they're still gonna import from China because it's cheaper
to sell a phone for $1,300 than $1,900. You know, obviously Apple's probably paying half this to make it. So maybe when they sell $800 phone, it costs them $400 to make everything. And maybe with the China tariffs now cost them $650 to make everything. So they're just going to pay. They're still going to double. I don't know how their markup. I'm just assuming they double. They're still going to double whatever they make it for. But now it cost them $650 to make it instead of $400 to make it. So iPhones now cost you $1,300 instead of $800. But it still doesn't matter because they're not going to make it in the US, because even if they made it in the US, it's $1,900. So it doesn't make sense. They're going to still import from China and just eat the cost. They don't eat anything. It gets passed on to the consumer. I mean, if it's a small business, so just to give you, if I'm a semi-small business, I can't be that small if I'm importing from China. But let's just pretend I'm $10 million of annual revenue, so nowhere close to Apple size. And I make specialized, just whatever product you want to call it. All price. So if something before the tariffs, it cost me $400 to make it, and I would sell it for $800, I profit $400, so I get, my margin is 50%, because I just double everything. And then now if the tariffs occur, and then I have to pay a lot more, because some of the products I bought to make my you could just say I make handmade watches. It's just easier to say something rather than just. So say I make watches, specialized handmade watches, and now it cost me $400. I had to spend $400 in all materials. Some of the materials I bought locally, some I bought in China, but it cost me $400 to all the materials, and then I would sell the watch for $800. Now with the tariffs, it cost me $650 to make the watch. But if I'm a small business, I might not be able to sell it for $1,300 because I don't have that big of a brand name where people like, I have to get Scott's watches. There's no other watch in the world. There could be some people, especially friends and family that know me, but I might sell online, my watches online too. So a lot of people don't even know me. So there's no way they're going to pay $1,300 for the watch. So I personally, as a small business, I say, well, I'm just going to raise it. And everybody's raising their prices. So instead of $800, I'm going to go up to $1,000. Let me just fix this. That's one minute trigger. So I still spend $650 in supplies, my expenses just to make that watch, and I'm selling it for $1,000 now. So I still profit. I still profit $350, but I only have a 35% margin because I don't think my demand is going to be that high as Apple. Like I can't just double the price like I've done in the past because I don't have that big of a customer base. I don't have that big of a brand name. So I have to eat some of the cost. You have to eat some of the cost. And that's just how it works. Unless, I could test it out as a small business. I could, if I kept it the way it was and just doubled my expense, But if sales go down dramatically, then I just may have to just adjust prices. Or you could do other things. You know, maybe some of the items I put into the watch. Maybe I don't need all of that. Some of it is just kind of like visual to make it look nicer. So maybe I'll remove some of the parts or some of the like design. And then the watch isn't as good as before, but I'm still able to, instead of spending $650, and say I spend $100 once I do the watch, then I have a designer add some finishing touches on every watch. It looks real nice after they do it, but maybe it's $100. I don't need to spend $100. So now I'm down to $550, and then I could just sell for $1,100 instead of $1,300, and win those difference. SPY opens up higher, but if you want to, if you're interested, what I was talking about earlier, getting something done in the house, because there's people who have buy orders set. When a price goes down, the buy order is set. Not everybody has buy orders. Some people just in their head, like they're just thinking, they follow the market, and if they see it go down to 500, that's when they buy it. But if you want to see how many people are sitting on these are options, but you can also, I think there's a way to find out how many people. I don't know, actually. Does anybody know? Is there a way to see how many? Because if I put a buy order in, I generally don't do an option. I just buy the stock outright. So I might have a buy order or a sell order. If I have a stock that's $100, right, and if it hits 150, I would definitely sell it because I make a 50% profit. But you don't want to like just remember that, because what if you don't track the market that day, or what if it only hits 150 for like 10 minutes? That's why you put in a buy or sell order in there, so it automatically buys or sells it at the right price. But anyways, but you can look at options trades and extrapolate based off of that. So every option trade at a certain price, there's going to be like, I don't know how you come up with this, but I'm sure there's a way, maybe 10 times as many people who are willing to buy it outright. So this is the S&P 500. These are, is this calls or puts? I can't even, it must be calls. Okay, it's right here, calls. So this is to buy it. So it's in the money, obviously, in blue. So everything in blue is in the money. So you can buy a call option that's already exercisable. So it's already in the stock. It's already within the call price. So it's $534. So if you bought a $430 option, you can exercise it right away. But the premium is so high, that's why you have to pay $100 for each option trade. And you're not gonna make money by just buying and selling it. It still has to go up. But you're just paying a huge premium. And all this in blue is in the money. So anything below 530, 394. So I guess anything 533 or below is already in the money. So yeah, right here, 533, it's all blue. So it's already in the money. So you can exercise it right away. You wouldn't right away because you'd want it to go up a little bit. You would just probably lose a little bit, lose a little money. But here's where you can make money when it's out of the money. Anything above 533, that's out of the money. So that's why you see a lot more activity. So this last column is open interest. And this is volume. So open interest are people who are willing, who have a buy order in set already. So there's 8 contracts that will buy at 430. And volume is the actual volume of how many trades are in that specific. So the most volume, actually it's 41,000. Wow, 77,000. Okay, so the most volume people own S&P 500 contracts at 550. And that's the open orders. So at some point, these people will buy those orders. But unless you're trading options, I wouldn't worry about this too much. But it just gives you some insight into seeing it, into seeing how much interest people have at what price points. And you could do this for a stock too. But I wouldn't pick an April 17th call. There's no time. Like June 20th, it gives you some breathing room if you did so here's the open interest. And they also have implied volatility right here. So here's the open interest. So this gives you a sense at what price point, like would Tesla, if Tesla goes down, say to 230, what's the open interest? We already know the volume, how many contracts are out there in the market, but what's the interest? Because there's 3,600 contracts that will be purchased if the stock goes down below 230. And then there's the interest outside the money. So if there's a ton of interest at 400, which seems actually 500 is a big, I guess people like round numbers. Then it gives you a sense of where the stock will move, because once it hits 500, people do like round numbers. So Tesla right now is 252. There's a lot of people who will sell if it hits 300. Whether they bought, whatever they bought it at, they may have bought it at 220. They may have bought it at 400. But there's a lot of people who put in orders to sell it. So this is it gives you a little insight. I mean, I wouldn't use it to trade, but it does give you information, especially if you're trading options, and this definitely makes sense. And I don't really trade options, so. Shadow guy. Most times I tune in, Scott is looking at options. Yeah, European options can only be exercised at the expiration date. You can't trade options in Europe. In the US, you could trade options. You can buy an option and sell it at any point, not just on expiration date at any point. European is only on expiration date. I had been selling puts to be assigned, but the price action was moving. So if you want to buy a stock, instead of just buying it, you can sell puts. So to give you a little lesson, I'm going to try to, there's the community center, because I have like another business. It's like an artsy type business. But we do like classes to teach kids how to like sew. But there's a community center that kind of advertises for us, because if people sign up for classes through the community center, then they get like 20% of the revenue. But I'm going to try to start doing classes like stock market classes or entrepreneurial classes. I think that would be really good. Kids, even for adults, but I think it's mainly for kids. It'd be better for kids. Adults are hard to work with. So from a high level 10,000 foot perspective, so obviously when you buy a stock, you're longing the stock. You want it to go up. When you sell a stock, you're shorting the stock. You want it to go. You want it to go down. So when I say long, I mean you want it to go up. Short means you want it to go down. So when you buy a call option, you want it to go up. You're longing the stock. When you sell a call, you're shorting the stock. You want it to go down. When you buy a put, you're shorting the stock. You want it to go down. And when you're selling a put, you're longing it. You want it to go up. So this is kind of like options. There's time. There's time decay. So it doesn't work out like this perfectly. But generally, when you buy a call, you're hoping the stock goes up. And when it does go up, you make money. Now, you might not always make money due to time, but I don't want to get too into the weeds on that. But I think you understand when you buy a stock, if you spend $100 on a stock, if it goes to 105, you made $5. And if you own 10 shares, you made $50. I think that's pretty obvious. It makes sense, right? It's pretty much one for one. And when you sell a stock, if you sell for 100 and it goes down to 90, you lost $10. You didn't really lose anything, but by selling it at 100 instead of 90, well, I mean, sorry, you made $10. You didn't actually make any money because you sold it at 100 and it went to 90, but you sold at a good time, I guess you could say. And if the opposite happens, you sell for 100 and it goes to 110, you lost $10. You didn't actually lose anything, of course, but you lost the ability to sell it for 110. So when you sell, you're kind of shorting the stock. You hope it goes down, and if it continues going down, you're happy. It worked out for you that sale. When you buy a call, as it goes up, your call becomes more valuable. When you sell a call, if the stock goes down, the call becomes more valuable. And same thing when you buy a stock. If you pay $100 for a stock and it goes to $1,000, you're happy. You made a lot of money. You do own it too, which is great. Because now each share is now 1,000 instead of 100. But when you sell a stock at 100, it goes to 0. You're loving life too, because you saved yourself $100 by selling it now. Anyone have quant data account? Is it worth it? God, have you ever heard of Constellation Software? I've heard of Constellation Energy, Constellation Software. Actually, I think so. I gotta look at Constellation Brands. No, oh, Constellation Software. Oh, it's a Canadian company. Okay, I'll be right back. Okay, well, Constellation, yeah, gold is doing well, right? It's a good hedge. I guess they were right. Let's look at gold before Constellation. Yeah, that's trading at an all-time high. Yeah, so you can see gold from 2011 to 2023. It didn't really do anything. Just came down and back up. But yeah, with all the volatility and everything getting more expensive, yeah, gold is just killing it. So that would have been a great time to invest. You could have got a 20% return already this year in gold. Yeah, Constellation. Actually, I'm not familiar with Constellation Software. Yeah, it's a Canadian software company. So this year, it's actually up this year. It was up a lot. It was at 5,000 Canadian dollars. Is this right? It's been around a long time, since 2008. It's a Canadian software company. It's a big company, 56,000 employees. It's been around 30 years. It acquires software companies. Okay, so it just buys. It's like a holding company. It's acquired over 500 businesses since being founded. It focuses on vertical market software. Most of its acquisitions are small, less than 5 million. It acquired Ekio Solutions for 250 million. So it's usually small companies, but it did acquire a few big ones. They spent 700 million on one. So it's kind of like Berkshire, where a lot of its, or some of its revenue is not public companies. Like 2/3 of its revenue are from publicly traded companies, but 1/3 was private companies. So that's hard to value a private company than a public company because you don't have access to the financials. 12% from Canada, half its revenue in the US. It seems okay. I mean, you're not going to get, generally, you're not going to get an amazing return for a holding company as you would if you bought a stock, but there's less risk. Although their stock has done really well. I mean, it hit 1,000 in 2018. So from 2018 to 2025 at 400, it went up 4x, 400%. So that's a pretty good return for a holding company. I don't know if you could get that type of return again. They're at these levels. But yes, same thing as Berkshire. It's a holding company. It just buys stock in other companies. And it looks like they're doing a good job at buying stock. They pick some winners. The revenue, they don't have any revenue. The companies they own have revenue. The revenue of the companies went from 5 billion to 10 billion in 3 years. And the profit is the profit of underlying companies. So they're profitable overall. Lots of cash flow. So yeah, it seems interesting, right? There's a book called The Hundred Bagger. Hey, Quags, the CEO Mark Leonard is compared closely to the likes of the best capital allocators like Buffett. Yeah, I believe it. I mean, it seems like he's doing a good job. He was a venture capitalist. On Wall Street, so he was he worked at a big firm. I'm sure we can figure out what company he worked at. It could have been like Goldman Sachs or JP Morgan. And he kind of managed one of their funds. Investors, buy into a fund like an ETF or a mutual fund, and then the money that comes in, he would have used it to buy other companies. And that's how it's like any ETF or index. You have someone like this behind it, and that's why you pay the expense ratio. Well, there's no, it's not a fund. It's similar to Berkshire, like a holding company, but he just holds stock in other companies. But what he did before, it looks like he just managed a fund at whatever company he was at. It doesn't really matter, I guess. Yeah, he probably worked for some Canadian venture capital company. It looks pretty good. It looks like they're doing well. The problem is, anytime you learn about stuff like this, it's kind of like past the point of a good investment, because you usually learn about things when other people are talking about it. but yeah, it's what are your favorite stocks that you're looking at? All your money's in this company. I mean, it could be worse. You know, that this is they own a lot of companies, so there's some stability. Generally, like a company like Berkshire or an ETF, they own so many companies. It's pretty much impossible for Berkshire to go bankrupt unless Apple goes bankrupt and all the companies they own go bankrupt, which can't really happen unless the world shuts down. Looks good. Yeah, I would let's see, in 2016, the founder. Okay, so somebody sued. Okay, yeah, there's always stuff like this. In 2018, the company canceled its quarterly earnings call. An unusual step for a public company. Analysts suggested the company took this step because it was worried about leaking information. That's pretty cool. Yeah. Is Buffett still holding Union Pacific? Probably. CEO doesn't take a salary. So that makes me feel good when a CEO does not take a salary. Because if you think about it, they probably are worth like $200 million. He's probably worth, let's see how big the company is, 96 billion. I bet he's worth like 10 billion. Like, why does he need another $300,000? They might not have all the information. Usually US stocks, you can find all the information. But for foreign stock, we'll see. I'm looking at the biggest shareholders. See, look, he owns 2% of the company and he's worth $2 billion. So he doesn't really need $1 million a year in salary. It's kind of silly because if you think about it, so if you're worth $2 billion, and you take a $1 million salary, it's 0.05% of your net worth. It's kind of like I'm trying to compare apples to apples. Okay, so say we view $100,000 as a good salary. Like if you made 100,000, nobody would make fun of you. Oh, you're really struggling. I'm not saying you're rich, but generally it's considered a good salary. That's equivalent if your net worth was $200 million. That's apples to apples for him. If you were worth $200 million, when I say net worth, the value of your assets minus your liabilities. So if you own stock in a company, if you own your home, all your shares, $200 million. Even if you ran a company, your own company, and you took no salary, people wouldn't say, "Oh, you're amazing." Like, well, they would say, you know, you're not taking a salary. That's really cool, but if you're worth $200 million, you could see why you don't really need the money. I mean, most people take the money, even if it's $200,000, but you can see why you can easily live on $200 million without taking a salary. So it's kind of like same thing with him. Like the average CEO gets $1 million, for instance. $1 million to him would be $100,000 to you if you were worth $200 million. I'm just telling apples to apples. But that's really cool when you see a CEO not take a salary. Buffett is like that too. I think he actually takes a 100,000 salary or something like that. But some private companies report their financials to issue debt. Yeah, no, it's true. Private companies, it is harder to get the information, but some do. And the more kind of like help you need from people, when I say help, the more like banks you need money from, or the more investors you need money from, or the most is when you become public, then you need money from millions of investors. So anytime you reach out, you're going to have to share your information. So in order to keep it private where nobody ever sees your financials, you can't ask for any help. Even like your brother or sister, like if you say, can you give me $50,000, they may want to see your books, and they may share it with somebody. But when you need funding from anybody, you're going to have to share your financials, especially if it's a bank. You're definitely going to have to share it. So the only way to keep it private is to never take money from anybody, including the government. Okay, so well, a fun stream. I think it's good to kind of look at these types of things, and I learn a lot too, because some of the things I know, but some of it's a refresher. So it's good to kind of talk through it. And of course, I didn't even know Constellation Software before today, so I'm definitely learning also from the stream. Yeah, so thanks for joining. I'm going to try to do, I think, scratch offs on Friday. I'm going to try to do it every Friday. I know some people don't get it, but I enjoy it. It's just fun. It's relaxing. And I'll do a stream on maybe Saturday or Sunday. Okay, thanks a lot. Enjoy work tomorrow. I know it sucks, but okay, talk to you later.